So this is the Commitment of Traders report, and here we have something very bizarre going on. Something that I'm trying to figure out, but it's really hard to wrap my mind around it because some stuff that is happening now hasn't happened before, and it's just totally bizarre. So here we have the gold futures, and what you see here is the price rose, and the commercials got more short, the speculative funds got more long, yet the total open interest, the total number of contracts, fell. So that means that the percentage that the commercials make up of the total open interest rose to over 40% again. So it's quite a commitment here. They're betting that the price of gold is going to fall. But then you look at silver, and it's just exactly the opposite, so much the opposite that I've never seen a Commitment of Traders chart so bullish for silver. You have open interest that rose. You have commercials that almost do not exist. You have the non-commercials that are always wrong in the short term. Whenever they bet heavily that the price is going up and they get very long, the price falls. And during that fall, they cover their contracts and close out their positions and lose money. And so here, they're betting that the price is going to go down. And you just don't see this. You've got to go back many, many years to see it. And they're betting now, there's 3 weeks in a row that they've been betting that the price is going to go down. And when you look at the commercials, they've almost disappeared. So with this increase in the volume of open interest and the commercials almost disappearing, the commercials' commitment is almost zero. Now, the commercials are the ones that manipulate price in silver to whatever extent they do manipulate. I mean, there are people going to jail over this. There are banks that have been found guilty. The proof is out there. They are manipulated markets. But I don't think they're quite as manipulated, at least for silver, as Ted Butler suggests. They are manipulated, and I do agree with this, and I've always stood behind Ted Butler. But here, what we see is the gold chart, and you can see that since in this whole century pretty much, since 2001, they've just been net short on gold. And then you get back into the last century and you see them net long and then net short and net long and short and net long. And this is completely unmanipulated back here. That's like normal price action. There is one very bullish thing. During this entire fall, this correction that has been happening since 2011, where gold went from $1,900 and it's fallen down to the near 1,000 range, and we're up at $1,300. That whole time, they stayed on the net short side. So this is bullish news over the long term. But when you take a look at silver, one of the pieces of evidence that Ted Butler uses to prove that it's manipulated is that they're always net short, except for there's a couple of months here where the non-commercials got net short, the speculative funds. But otherwise, the big commercials are always net short. Well, there's actually a logical reason for that. Silver, all of the gold mining companies, they're in the business of mining gold. And that's where most of the gold supply comes from. There's a tiny bit that comes from scrap. But almost all gold supply comes from gold miners. Silver, on the other hand, 60-70% of silver's annual production comes as a byproduct from mining other base metals like copper, tin, lead, zinc, and so on. And gold. But very little of that comes from gold. Most of it is from copper, lead, and zinc. And so the fact that we're seeing this Commitment of Traders action where the commercials have almost completely disappeared from the market suggests only two things: that the commercials think that the silver price is going to explode and gold isn't, or it's suggesting that there is going to be a worldwide global slowdown and that the amount of silver that is actually being produced as a byproduct of mining copper and tin and lead and zinc is slowing down. Copper is used as plumbing pipe and wiring. And most of that's driven by the Chinese housing boom and the rest of the world that's in a real estate boom right now. And zinc castings for cars and lead for lead-acid batteries for cars. So if that's starting to slow down and there's less silver being mined by these companies, now remember, they're in the business of mining other metals, not silver. Silver is an annoyance to them, but it's a valuable annoyance. So when they get silver, they sit on it for a little while. It isn't important for them to sell it right away, especially because it's so easy to just store it and then sell a futures contract and get some cash out of it that you can work with. They've got the silver, so this is a covered position. They can deliver into it. They've got the silver behind it. It's not a naked short position. It's a covered short position. And so they're sitting on silver. They sell a contract. That means it's now hedged and the price doesn't actually fluctuate anymore, regardless of what the price of silver does. When the price falls, the contract goes up because it's a short contract. If the price rises on silver, the contract falls. So when whatever they agree to when they sell the contract, that's the price that is locked in on that silver, and they've got that cash to work with. So there's a reason for them to be sitting on silver. There's a reason for them to be net short for these producers. But this action that has happened lately is the most bullish thing, because it says that either there's a global slowdown coming, which means that just when people want to rush into gold and silver, there's also going to be no silver available. The production is going to disappear, or it means that the big commercials believe that the price of silver is about to explode. And this, the gold-silver ratio, is what is going to be correcting. Right now, there is this rare opportunity. It's above 80 significantly right now. And we had a few weeks in 2016 and several weeks back in 2009 and a week or two back in 2003 where you could have bought silver at this. Right now it's cheap compared to gold. So this is a huge opportunity that I see, and recently I just made a significant purchase of silver again, and it was because of this and because of the commitment of traders. But I want to show you one other thing. There are certain times when there's an opportunity to buy that are better than others. Now, this is the price of gold, and this is a 3-year graph with the 50 and the 200-day moving average. And whenever you can buy when the price is below both of these lines, that tends to be a very good buying opportunity. You want to buy when the price, and right now, gold is above both its 200 and its 50-day. And silver is below its 200 and its 50-day. And so you've got the commitment of traders report, you've got the gold-silver ratio, and you've got the fact that in the short term, you've got one of these buying opportunities where it's below both of the moving averages. This is a close-up of gold, and you can see that it's well above both lines. And here's a close-up of silver, and you can see, this was yesterday, it fell today, it's back below the 50-day moving average again. But anyway, I just recently made a purchase. I believe I made it back here because of all of these things and the way they add up. Now, another thing I want to point to is that I like to buy when everybody else doesn't want to buy. That's when you want to accumulate things. Recently, people have actually complained that I've been making too many videos about cryptocurrencies. And so the public doesn't want it. We stopped making public videos on YouTube about cryptocurrencies because nobody wants to hear about it anymore. I'm going to get back to that in a minute. But here's gold. And right now, a lot of people don't want to hear about gold. This is the U.S. Mint's coin sales of gold coins. And what you see here is that it's gone from over 130,000 ounces per month down to below 5,000 ounces, 4,500 ounces. So this is more than a 95% drop in sales since 2009. 95%. This is an amazing capitulation because the larger funds and stuff, they'll buy things like GLD and they'll do futures contracts, but the individual investors, the small investor, typically buys things like gold eagles and 1 ounce bars and things like that. And you're seeing a major capitulation here. And then with silver, that's again a different story. But back in 2008, 2009, the average was about 1.5 million ounces a month, and then it rose to about 4.5 million ounces a month in 2015, 2016. But now it's down. If you average this out, you're at less than 1 million ounces a month. So it, again, has fallen almost 80% or more than 80%. So again, when you add all of these things together, this is a very, very bullish sign for the precious metals. Now, when it comes to cryptocurrencies, I mentioned the 50 and 200-day moving averages, and I mentioned that nobody wants to hear about cryptocurrencies anymore because a lot of people that bought when cryptocurrencies were real popular and Bitcoin was up near 19,000 are now underwater. I made some videos where I took some profits up in these areas and converted into silver. Got a lot of flack from the cryptocurrency community for that.